What a challenging time to be an investor. We're seeing rising inflation while economic growth slows, which conjures up real concerns of dreaded stagflation. At the same time, we're seeing asset valuations stretch to many of their highest levels on record, raising worries for a painful correction in the markets. What are prudent options for investing during daunting market conditions like these? Well, the answer may lie in anti-bubbles.
We're looking at assets that are grossly artificially cheap based on a misconception. As such, it's a matter of when, not if, that the anti-bubble will explode higher. Okay? So they are a form of extreme value. The second dimension of the concept is assets that they're effectively a mirror image of the bubble. Bubbles and anti-bubbles are two reflections of the same process. They're effectively driven by the same misconception. So by construction, the moment the misconception is understood, the bubble and anti-bubble move simultaneously. That's why I use it as a hedge.
Hello and welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another week of making sense of money and the markets. This week we're joined by a wonderful guest that's been requested by a number of our audience members, who is a partner at Quadriga Asset Managers in Madrid. He's got 20 years experience working for major Wall Street firms as a macro analyst and a money manager, specializing in commodities. And he's well known for advocating that during times of high speculation like we see in the markets today, savvy investors can benefit by identifying what he calls anti-bubbles to put their capital into. I'm talking, of course, about Diego Parrilla. Diego, thank you so much for joining us today from your offices in Spain, no less.
It's my absolute pleasure. Thank you so much.
Well, thanks. Well, Diego, let's start with a question I like to ask all of our guests before introducing any possible biases on my end, positively or negatively. What is your current assessment of today's economy and financial markets?
Look, I think to put some perspective, I think we're in a paradigm shift. I would summarize the last decade as the transformation of risk-free interest into interest-free risk. And what happened throughout the past decade with artificially low interest rates, infinite amount of liquidity and monetary and fiscal policies without limits, what we've done is we've basically created an artificial setup, which has led to what, in my opinion, are bubbles that by now are too big to fail. So we find ourselves in this situation where the past decade, which has been turbocharged by COVID and the monetary and fiscal response, has led to these enormous bubbles that are systemic. So think about what would happen to the economy, to the world, if interest rates were to go up, if things were to be normalized. So I think to your question on the economy itself, I think there's still a significant disconnect between where the economy is and where the markets are telling us, with effectively valuations near or at all-time highs. The problem with this, as I mentioned, is these bubbles that are now systemic effectively will lead into what I think is the next decade. The next decade for me is, in one sentence, is the transformation of bubbles into inflation, or perhaps more accurately, stagflation. So I think this process by which we have created these monetary and fiscal policies without limits, this idea that you can actually solve problems by printing money and taking debt, it's a fallacy. You're not solving any problems. What you're doing is several things. You're delaying the problems. You're kicking the can down the road in the form of debt and intergenerational issues. Second is you are transferring the problem in the form of currency wars and trade wars, basically trying to pass the problem to your neighbor and defending yourself. We are transforming the problem into inequality and inflation. And unfortunately, we are enlarging the problem in the form of bubbles and social. And so this dynamic is very obvious if you're in Latin America and Argentina or Venezuela. This idea that you can solve problems by printing and borrowing money, it's obvious what the outcome has been. And I think in some ways, the world is going into these two paths, the Japanification of the world and the Argentinification of the world. And it's a world that overall is, from a market's perspective, things are extraordinarily artificial and way more fragile than they may look. And these bubbles that are now the real systemic risk will lead to a process where every shock is met with more of the same, more money printing, more debt. And this will, in my opinion, lead to this dynamic of inflation accelerating within a not very healthy economic setup, which is the absolute nightmare scenario called stagflation.
Okay, so that is not a terribly rosy outlook. Not that I disagree with any of it. You had a lot of great points in there. I love the expression, by the way, of transforming from risk-free interest to interest-free risk. But you talked about this sort of collection of bubbles that you see the world in right now as being too big to fail. And I think by that you mean sort of policymakers will step in whenever needed to try to keep them going for as long as they can. And you see that manifesting in kind of a chronic stagflation. And I guess when we think about bubbles, we always sort of think about the inevitable bursting of the bubble and the deflationary aspects that has in the price deflation. Do you see this manifesting at some point in, is this period punctuated with deflationary periods as the bubbles correct and then the central planners step in? Or is there just sort of a universal commitment to do whatever it takes to keep them inflated, and we're not really going to have a crash? We're just going to end up in sort of a currency crisis worldwide, where the fiat currencies are basically destroyed in the pursuit of trying to keep these bubbles elevated?
I think all you said is correct. I think basically if this was a chess game and you're looking at the possible moves, we're in this situation where by trying to avert the collapse, I mean, let's look at Q4 2018, okay? And let's put some history before that. We had a situation where, throughout, from 2008 to 2018, we have had this process of, 2015 rather, QE, then negative interest rates in Europe, infinite amount of liquidity, blah, blah, blah. We got to the point where we decided, okay, things are a little bit better. Let's normalize things. Let's taper the programs, and then let's hike rates. And we were in this steady mode where, in a funny way, if you look at the relationship between long-term rates and short-term rates have been a reasonably good predictor of how high the tightening cycle can go before you blow up. So it's almost like the bond market it has a lot of information, and that level was around 6.5% 2001. It was around 5% in 2008, and we didn't quite get to 2.5%, 3% when things blew up in 2018. And I think that was the point. Goldman and others were calling for steady hikes and things to go way higher. That was a wake-up call for central banks who said, oh my God, of course, we've built all this debt for the past decade, and ceteris paribus, if we put rates back to where they were, I need to pay twice the amount of interest, right to serve it. So in a funny way, there's a very linear relationship between ceteris paribus, assuming constant duration or whatever, between the amount of debt and how much you pay. And we're in that situation where, that if you hike rates, the system will blow up, and it will do just by its own weight, right? And so the question is, they're obviously going to trying to find this fine balance between, okay, how do I avoid the thing from collapsing by giving some support and hoping the economy catches up with the markets, whilst the degree of freedom is perhaps overheating the economy with too much liquidity, too much fiscal, too much whatever. And this is the fine line, and this is why the moment where we're today is so interesting in terms of the paradigm shift, because I believe we're in a way changing the rules of the game. So what you described in some way also is what does the textbook say? The textbook says, look, if inflation comes, we hike interest rates and that's it, right? The problem is that if inflation comes and you hike interest rates, by hiking interest rates, you blow the bubbles, which are deflationary, and you no longer have the inflation problem. So what do I do? Do I hike rates and blow the things off? Or what do we do? Or do we let them run and prevent them? And I think the approach from the Fed, it's clearly telling you, dismissing any kind of inflation. First of all, they've been telling us for a long time that the enemy is deflation. Guys, the enemy is deflation. We really want and need inflation. Then you're starting to get inflation. Now it's being argued that it's transient, is temporary. And there are a lot of things that are telling us that, again, this inflation-deflation debate is fascinating because, as you well pointed out, the extremes are not that far from each other, okay? And it's right. more of a circle than a straight line. And you can look at the deflationary forces in the system, and there are plenty of them. Unemployment, poor economic activity,
demographics,
technology, demographics, overcapacity, malinvestment. All these are deflationary forces, which have been so strong that there's been some kind of freebie for central banks to print as much as they want without really creating an inflation. But that process of apparent stability is actually the offsetting of two pretty large forces, where the printing side is only gotten bigger and bigger and bigger. And I think in that set, the risk of the bubbles is meaningful, and they would be very deflationary. You're correct. My view is it's a little bit like what happened in the US with MMT, right? Do I let all these people lose their jobs, in which case I need to pay them benefits and then hope that they get back? Or do I just pay the companies, to prevent them from laying people off, because I'm going to have to pay anyway, so I might as well do it up front. And so the central banks are just saying, and governments are saying, guys, and we can do this, by the way, without increasing taxes, because we have this great guy here called the central bank who's going to print its way to infinity just to finance us. And I think that creates lots of issues. You mentioned the currency debasement and wars. I think one of the risks is the US is in some way abusing its position of power, right? By in some ways clearly favoring, as you would expect, the domestic US guy. So if you think about, let's print $5 trillion, if you're a Chinese saver or a Japanese saver or a European saver who has treasuries as dollars, you have that money because you have faith that they will respect you, they won't dilute you. But what's happening in some ways is a very clear support for the domestic guy at the expense of whoever owns dollars. And so this process of, in a way, abusing your position of power, trying to dilute the dollar, using the dollar to finance the expansion and do it without increasing taxes is like just panacea, right? But there are some costs in the process and some checks and balances. And we know, we mentioned some of them, like inflation or inequality. And these are things that are real, and they will lead to other effects, such as taxation, trying to bring things all back. And it's all part of the same circle. But yeah, I think the problem, if I may say so, or there are different ways to look at it. But from an investor's perspective, how the hell do we position ourselves against this myriad of issues? And I like to use the analogy of a team, right? When you build a portfolio, you need a team. And there are really two key dimensions you need to take into consideration. The first one is some sort of risk on, risk off balance. It's the idea of, where the trigger is volatility. Okay, I think volatility is the key anti-bubble or anti-bubble in the system. It's the measure that effectively, as an engineer, I use the analogy between fluid mechanics and the markets. You know, you have laminar and turbulent regime. The markets are laminar or linear or well-behaved in a low volatility environment. Once volatility breaks above X, call it 40, volatility, effectively the market becomes chaotic, and this chaotic level creates a process of increased volatility, increased value at risk, forced liquidation, polarized correlations, forced liquidity, and then things collapse in a very mechanical manner. And this dynamic, when you think about the portfolio, you need strikers, you need defenders, you need both pieces, but you also need to consider from a long-term perspective whether those strikers or defenders are long or short inflation. And I think today you need to be mindful of those bubbles and the risk that they blow up, because central banks effectively lose control. But you know that if and when they did, 100% guaranteed, they're going to come back with more of the same. And that more of the same will be yield curve control, will be more printing, will be more stuff, which will try to bring things back. So plan A, and the ideal scenario for them is they create sufficiently high inflation that it dilutes the problem over time, but not high enough that it will get the frog to jump out of the boiling water, and to do it in a way that you're avoiding the collapse. So I think the priorities is let's avoid the collapse, let's let inflation run, but hopefully not too hot. And this is the very, very fine process they're trying to run with the danger that every time the bubble's higher and you're really facing more downside and more asymmetry. So it's really, you know, all these variables that we as investors need to play to try to protect ourselves both in nominal and real terms, which is the name of the game right now. Is dramatically changing. You know, if I have a teenager boys, right, and if I have to explain them the markets to them, I'd say, look, they play video games, right? I'd say there's 3 levels in this video game, right, called markets. The first one is you need to make money in nominal terms. So you need to turn $100 into more than $100. That'll be level 1. That's easy, okay? You can put money in fixed income and that's it. You made some money. Level 2 is, can you make money in real terms? So can you actually beat inflation? Now, pretty much the entire spectrum is in negative real yields. And the third one, which is yet to come in a bigger way, is can you make money in real terms after taxes? And this is how they close the circle and how this mess keeps evolving. But I think it's a very clear direction of where we're moving, with the risk of bubbles and inflation being both huge and relevant.
Guys, so many great things in what you said there, and I actually love the video game analogy. And I think that level 3 is probably going to get a lot harder going forward too. Looking at government regimes, and certainly in America, you know, we're seeing an increased appetite for taxation going forward. So you talked about the thread as sort of trying to thread a needle here, right? It's stuck between fire and ice, right? If inflation runs too hot, it's got to raise rates. And then if that happens, you risk, you know, bursting these bubbles, collapsing the system. So question for you, Diego, do you expect with your best guesstimate, do you expect the Fed to largely be able to finesse that so that that line is relatively stable and steady? Or do you see us ping-ponging back and forth between the ceiling and the floor here? In other words, a much more volatile future going forward where the Fed is dialing up, dialing down, dialing up, dialing down. You know, how smooth can they make that trajectory in your opinion?
I think if I was in their shoes, what I would play is, and the way that I think they will do this is, and this ties into the debate of tapering and hiking rates and yield curve control. And what could be interesting is it's pretty obvious and very difficult to justify that you continue to do 120 billion a month. Okay, that's just out of scope with the level of recovery, with COVID, you know, hopefully coming out of the woods, and the markets are all-time highs and whatever. So it's really hard to justify So the tapering, the T word is scaring the hell out of a lot of people for the right reasons. But if they do, it's going to be a very slow process. It's going to be glacial. So they might say, okay, we'll start tapering, but guys, don't worry, it'll be 110 for a while, right? So the market gets open to the idea, and that tapering, it's less, but it's still happening. The second thing that I would expect is they may combine it with some sort of operation twist. So they say, yeah, I'm going to buy less, but you know what? I'm going to buy it with longer average duration. And this is really a very smart way, in my opinion, to remove some degree of accommodation, but increase it through duration by keeping long-term rates. And that would be actually could even be a positive news for the market. So you could see a taper scenario. It's obviously incredibly supportive for things like gold and other assets, but it could well be that if they let this run too hard, too long, they will have to respond with yield curve control even before they have an opportunity to taper. So this is where it's interesting. So far, for example, the Bitcoin volatility or other events we've seen recently, like Archegos or others, or ARC, they haven't really had any meaningful event yet. I think part of the reason is because the stereotypical crypto guy is unlikely to be in the S&P. It's probably in something more esoteric. So it's not like, but they are short gold, so they've been buying gold. But I think that's going to be an interesting one. So the question for me is, if they let it run too far, they run the risk that the bubbles start to hurt, whether it's because of their own weight or some catalyst, in which case they will do YCC yes or yes. Or if the market holds and they decide by Jackson Hole or whenever to taper, whether you do that on a standalone basis at glacial pace in conjunction with yield curve control or operation twist. And in any scenario, even if the taper takes place and the amount of buying is reduced in the speed at which is happening, the pace, you would still be a long way before you hike long-term rates. And that continues, short-term rates. And that continues to feed the pressure for inflation, which is giving them time to try to dilute the problem. So I think one way or another, whatever they do, they'll be very cautious, and they're always going to err on the side of let's not upset the markets, and we'd rather overrun and overheat from the inflation side rather than risking the bubbles. And that only creates bigger bubbles that make the problem harder to manage later. And that's the fine balance.
Yeah, we have a lot of people here watching this video who are concerned about current levels of valuation, or maybe better put, levels of overvaluation based upon historic metrics. And so there's a lot of people that are worried about, putting money into this market because it could correct by a large amount. You have the Jeremy Granthams of the world who are, out there pretty publicly saying, hey, just when we've seen these market factors in the past, it's always been followed in the near term by a 50+% market correction. Now, nobody knows, the future. That may or may not happen. Sounds like you think the Fed is going to try to be as cautious as possible, to not unleash the volatility monster. But the Fed isn't all powerful. So anyways, I want to move on to the team that you think is the right team to recruit for a portfolio in this type of environment. But I guess real quick before we do, two things. One, if you could just comment on what I just said there about volatility and Grantham's crash. In other words, how much do you fear things just getting out of the hands of the central planners in the short term and leading to a very sizable market correction? And then if you can, after answering that, talk about, I mentioned the term anti-bubble when I introduced you. You have this sort of framework and outlook that involves investing in anti-bubbles. If you could just define what an anti-bubble is before we get to recruiting a team to invest in them, that'd be great.
Sure. So let's start with the volatility. And I think volatility is an anti-bubble. I'll discuss shortly what it means. But I think volatility is, which can come any minute, any second, for any reason. It creates a very mechanical process that, as I described earlier, moves the market from a laminar regime to a turbulent regime. And in a turbulent regime, the process that follows is, as I said, mechanical. It's really difficult to stop it. When I use the analogy of driving a car at 200 miles an hour when the speedometer says 80, right? If you have an accident, boom, what do you feel? Well, you feel the real speed you were running at, regardless of what the speedometer said. And this is a little bit what happens with volatility. You might have low realized and implied volatility might give you the perception that you don't have a lot of risk in your portfolio, but the risk ex ante is what it is whatever you're running. So people might be running way more risk than they're aware. So once volatility starts to go up, both implied and realized, your value at risk goes up. Your boss calls you and says, cut risk, or your risk manager, or your stop loss, or whatever. And that creates a process where, as volatility goes up and the value at risk goes up, you're forced to reduce positions. If everybody has the same trade and liquidity starts to thin up, and then effectively this forced liquidation it's very simple. Once volatility explodes, it's 100% about speculative position in the market. 2 + 2 is no longer 4. It's just about the specs. You look at the orange juice market, the orange juice market's up, it was short. Silver is down, it was long. Gold is up, market was short. There's nothing to discuss, okay? It's very mechanical, very simple. And this process where correlations actually polarize to +1 or -1 creates an exponential increase in value at risk, which is a function of both volatility and correlations. And this is something that it's the reason why when these things are very difficult to stop, and they go way farther than anybody anticipates, because it's your risk parity, your trend followers, your vol targeting are being stopped out. The mirror image of that is what we're seeing lately. So volatility collapses to 18, 17, and it's dragging in all these guys. So it's the guys that buy things at 17, 15 vol that puke at 25, 30 vol, and they compound the effect. So volatility is critical, and you need both legs in your portfolio. You need things that will be asymmetric and make you money, in both regimes. Another point I want to mention related to Grantham's and the crash is a very important point that I don't think people understand well enough, okay? And you mentioned, and correctly, that most people agree, not just your listeners, but most people would agree that equity valuations are high in absolute terms. There's not really much to discuss, okay, about that. The debate is more about the relative valuations, okay? What people call risk premia or equity risk premia. And what equity risk premia is trying to do is basically saying, okay, let's try to compare apples with apples. So we all know what the yield on fixed income is. It's a pretty simple computation. The implied yield, the 10-year treasuries are yielding X or 30 years Y. But when you try to create this idea of equity yield, right, by effectively creating some sort of models that look at as if they were some sort of bond, and then you compare the premia, the equity risk premia, you find very interesting things. I mean, to start, one of the things you find is that people are comparing things like the S&P or the NASDAQ to 10-year treasuries. Okay, if you actually, this is a very basic mistake. Why? Because if you actually look at the yield and you do the model for your S&P or the NASDAQ, and you actually work out the duration of the sensitivity to interest rates and the duration of those, our analysis shows that the S&P has about 28 years of duration. The NASDAQ has 40 to 50 years of duration. Okay, so when you think about what happens to long-term interest rates going up, you obviously realize that the sensitivity of these things, you are looking at the more growth in the equity, the more sensitive to long-term rates. But what it shows is this fallacy that equities are cheap relative to fixed income. Because what you should do is you cannot compare apples with pears. If you want to compare, the S&P with treasuries, you should use like for like duration. So you should really be comparing the S&P with 30-year treasuries, or the NASDAQ with 40 to 50-year treasuries. And if you do that, you see that the equities are not only expensive in absolute terms, but also in relative terms. Okay. And this is part of the reason by which I mentioned that you cannot hike interest rates. Yeah, the back end is going up to a level that is sort of trying to predict how high they can go, short-term rates, before we blow up. But ultimately, the average duration, a lot of people, I don't know, here in Europe, for example, a very large percentage of mortgages are short-term floating. Okay, so it doesn't really matter what's happening to 30-year rates, because you're financing yourself at Euribor plus 90 basis points.
At the short end of the curve, yeah.
And Euribor is minus 50 basis points. You're paying, 40, 50 bips. So in that sense, you really need short-term rates to go before you see some of that impact. And that is very unlikely to happen. And I think the bigger the bubbles, the more pressure you have on the long end, both as a signal of how high you could ever hike before you blow up, as well as this response that you can't hike, therefore, you will see also YCC. I'm of the view, and this is a very contrarian view, that, and I've been saying this for a while, that we will have both inflation and zero rates. And this is a change in the rules of the game, because this is the way Europe and Japan have gone. It's my point that inflation it's more relevant and more important to prevent the bubbles from imploding than basically letting inflation run. And this is something that the bluffs from the central banks will be checked, and we'll see how they react and when, but they're going to be in a very difficult spot. With that, I move on to the concept of anti-bubble, and basically, which is the title of my book, and the concept that I coined, which is very simple in a sense. But let me start with George Soros' definition of a bubble, okay, or my interpretation. And Soros talks about assets that are artificially expensive based on a belief that happens to be false. It happens to be a misconception. So bubbles are basically processes where the emperor had no clothes, okay? Now, what I did as an engineer, I said, okay, I generalized the process. And by that, I mean, okay, misconceptions can distort reality, but not only with artificially high valuations, which we call bubbles, we could also have artificially low valuations, which is what I call an anti-bubble or anti-bubble, yeah, potato. So in that sense, there are three dimensions to the concept of anti-bubble. The first one is we're looking at assets that are grossly artificially cheap based on a misconception. As such, it's a matter of when, not if, that the anti-bubble will explode higher, okay? So they are a form of extreme value. The second dimension of the concept is assets that they're effectively a mirror image of the bubble. Bubbles and anti-bubbles are two reflections of the same process. They're effectively driven by the same misconception. So by construction, the moment the misconception is understood, the bubble and anti-bubble move simultaneously. That's why I use it as a hedge, and why I called it anti-bubble. It's a bit like an antivirus or an anti-missile. It's a defense mechanism against the bubble. And the third element of the concept is the idea of risk premium, of being a contrarian. The idea that, and I'll give you an example. If you think about the relationship between the S&P and the VIX, for me, it's a very clear bubble anti-bubble relationship. Why? Because you could have basically artificially low volatility can contribute to artificially high equity prices. And this happens both through qualitative drivers, such as complacency and perception of low risk, the fact that mommy and daddy will always be there to cover our back, and quantitative process, such as CTAs or risk parity or vol targeting, that are strategies that the lower the volatility, the more they buy. And so effectively, this concept of anti-bubble which I think it's now being widely understood and accepted, is powerful in multiple ways, and allows us, it gives us, you know, a tool to try to build portfolios in this highly artificial world. So with that, I go to the last part of your question, which was a very loaded question.
We hope you've been enjoying this conversation with European money manager Diego Parrilla. The interview continues in part 2, where Diego explains in detail exactly how he's allocating his portfolio for today's market environment. To watch part 2, just click on the link provided in the description below this video, or go to youtube.com/Wealthion. But before you go, please don't forget to click the subscribe button below if you haven't already. Oh, and if you'd appreciate a free, no-strings-attached portfolio review by a financial advisor who takes into consideration both the macro risks and the market opportunities mentioned by Diego, just go to wealthion.com and we'll set one up for you. Okay, I'll see you over at part 2 of our interview with money manager Diego Parrilla.